Okay, assalamu alaikum to all of you and a very good evening from my side. My name is Hamad Sarwar and I'm the host of this session, ACCA Practice to Pass for Paper Financial Reporting, FR. I've been in teaching profession for more than 15 years and I've been teaching this paper, and I want to thank ACCA for providing me this opportunity to interact with international students and nationwide students through this Practice to Pass session. And I'm dealing this practice P2P session for the last 4 to 5 years. So Alhamdulillah, I've got enough experience of this paper, financial reporting. So please write yes in the chat box so that we can start the session. If you wanted to ask anything, you can write in the chat box your questions. Please write in the chat box so that we can start the session. There's the details about my contact number you can see on the screen, and I have made a WhatsApp group for your support. So if you follow all the instructions that I will share in these sessions, you will definitely pass the examination with a very good marks. So it's all about the plan that we need to follow. So all of you are requested to please join the WhatsApp group. The management committee has shared my number, contact number, as well as the link for the WhatsApp group. Just click on the link and join the group so that we can discuss the core concept or anything that you are having some problem in the group. And you can even discuss with other members of the group as well. So let's start the session. Moving on with towards the first slide. Now this format of the examination, you can see on the screen, there are 3 sections of the paper. Section A will be having 15 MCQs, each carry 2 marks, and there will be 30 marks in total for section A. In section B, we'll be having 3 OTQs, objective type questions, of each having 5 requirements. And again, the marks for this section will be 30 in totality. And in section C, there will be 2 constructive response questions, each carry 20 marks, and the total percentage of this area is 40 marks. So I suggest the students who flunked in this paper previously that if you got flunked previously, the more focus that we need to do is on section A and B. So if you are weak in section A and B, definitely you'll be having a difficulty in passing this paper. So if someone got flunked previously, the more problem that that person should have to focus is section A and B. Because if you got 40% marks out of the 60 marks, then there will be only 10 marks that you need to gain from this section, section C. So if you score 40, in fact, not 40%, if you score 40 in section A and B, you only need to gain 10 more marks to pass this paper. So passing this paper is very easy. And secondly, if there are students who got flunked in the previous sessions, do contact me personally. I will share a special plan for you guys for those who got flunked. And for those who are appearing this paper for the first time, my instruction for those students is to follow all the guidelines that I'm sharing here on this webinar. This is a very important webinar for this paper, and you need to focus on the webinars. Don't go for the recorded versions. Try to take all the live sessions of this webinar. From the exam point of view, the time management is very crucial and important for the students. So there will be 3 hours for the examination, and total minutes that we have for the 3 hours is 180 minutes, and for which we need to take 100 marks. And for each mark, we will be given 1.8 minutes. So if your question is for 30 marks, then you can calculate the time that I need to give for that particular requirement should be 18 minutes. So for constructive response question, each having 20 marks each, the time that you need to do should be 36 minutes. So you should know the ratios questions, you should know the consolidation or the final account question or the cash flow question in 36 minutes. So if you're spending more than 36 minutes on section C question, that means that you are missing the time of section A and B. So time management is very important for this session. Will we be sharing the plan for the repeaters? I will share a separate plan for the repeaters or for the resetters, but you need to contact me personally on the WhatsApp number, and you have to tell me the marks that you have gained in the previous attempts and the number of attempts that you have already made for this paper. And after that basic question, I will share special and subsidized plan for you. Management will share my contact number along with the link for the WhatsApp group. Please join my WhatsApp group so that we can discuss all the concepts over there. So focusing on the next slide, moving towards, that's the pass rate for this paper. Apparently, you can see the as compared to the other papers, the passing ratio is good for this paper, but still, you need to say here that the average passing ratio is approximately 49 to 50%. And it means in every exam sitting, 51% to 50% students have to fail the examination. That's very scary, you know. So you need to prepare yourself that you can manage yourself in this portion of the students category who have passed the paper. So these are challenging exams. You need to focus, you need some guidelines. You must have to follow the plan that I'll be sharing with you guys. And it's very important to focus on the concepts, and the major success is the practice. Practice raises power 1000. So the practice is the success of this paper. Now that's my plan for practice to pass session. In day one, we will be focusing section A and B. Means we will be focusing on the key areas that could be examined in this attempt. So this session is specifically crafted and designed for the March 2020 session, 21 session. So I'll be focusing on only that portions or that areas which are important for this session, that is March 2021. So in day one, we'll be focusing on section A and B. In day two, we'll be focusing again on section A and B, because this section A and B can give you 60% marks out of total. So even if you leave section C, which you should not, but if you leave section C and just attempt section A and B, you can even score 60% marks, because these are close-ended area. So if your answer is right, you'll be having 100% marks. But if your answer is wrong, you can score 2 marks or you'll be having 0. So 100% marks or 0% marks. That's the risk factor of close-ended areas like section A and B. In day 3, we'll be focusing on the final accounts, constructive response questions. In day 4, we'll be focusing on consolidation, and in day 5, we'll be working on the ratios. So these are the 5 days plan. If you follow all the plan and the exam tips I will be sharing with you guys, and the most importantly, the home assignment that I will share with you. If you can see on the handout section, there will be 3 handouts. So handout with the name practice day 1. This is the home assignment for all of you guys that you need to submit it by tomorrow. Okay, there's a request from the student that shall we start with the consolidation. Yes, we can start, but believe me, I'll be discussing with you the most important areas that can be examined in this session. So I'll not going to waste your time, crucial time. I will inshallah focusing on the key areas in which you'll be definitely having some problem, and these will be the most important area for this session. So now these are the topics that usually examine in this section A and B. And if you see that examiner usually focus on assets on priority basis, the first priority the examiner usually gives is to assets and then liabilities. And then we're having other standards. What does it mean? What do you mean by assets? Assets means IS 16, property, plant and equipment. This is one of the most favorite standard of the examiner. Can be examined in section A, B, and C. So this standard is what you need to learn with the heart, from the heart. Yeah. IS 38 intangible assets, then IS 36 intangible impairment. These all are related to the assets. Then the government grant IS 20, borrowing cost IS 23. These all are related to the assets. Then we have inventories IS 2. We usually assume that um, we know about IS 2, but sometimes examiner can give you a dodgy question. Then we'll be having investment property and biological assets like IS 40 and 41. These are also important standards for section A and B. But these all are related to the assets exactly. Then held for sale assets, IFRS 5, non-current assets held for sale. So these are the standards. So if you see, the majority of the standards are related to assets. These are the most important areas of the syllabus for section A and B. Yes, all recording will be shared on the WhatsApp group, and it will be available on the Vimeo as well. But my recommendation for you guys, if you can manage to take the live classes rather than focusing on the recorded version. Where are we going to submit the answers? We need to submit the answers on the WhatsApp group, and then we will discuss the answers in detail. So let's start with accounting standards. Today, in day 1, we will be focusing on the assets area, and in day 2, we'll be focusing on the liabilities and other assets, along with the final accounts. So this area can give you 40% to 60% marks in the examination. And in day 3, we'll be focusing on the consolidation. And day 4, they'll be focusing on the ratios. Yes, I will share the solution of the answers. How long will this go on? This webinar is for 3 hours, actually, and on daily basis from Monday to Friday, 27 2nd February till 26th of February, there will be a 3-hour session daily basis from 8:30 p.m. till 11:30 p.m. And we might be having some break if you feel tired. But my focus is, do you guys really need to pass the examination or not? That's a very important question. If you wanted to pass the examination with very good marks and in first attempt, so you need to focus on the sessions. You need to focus on the assignments. Now, first most important thing that usually students ignore at this level is the exam resources. I'm sharing the exam resources for this paper. Usually, examiner students at this stage don't look at the examinable document, and they will be having a support English language course for this paper as well. Then examiner's report is very important. It's my recommendation to all of you to at least read the last two reports of the examiner, so that you can identify that why students were failed in this paper. This is very important. Then exam techniques, which have been shared by this examiner, some past papers, some FAQs, and most importantly, the technical articles. The technical articles. Let me click again on the. Yes, these are very useful articles for the students. If you read all these articles, then these are very well written by the examining team, and it is very helpful for the students who have got some problem in a particular area. But this does not cover the whole syllabus. This is all about the most important areas of the syllabus. These are the two questions that is your assignment till day 3. This is the question for September December attempt. The name is Lodun Company. Lodun Company. You can see the trial runs, equity shares, retained earnings, office building, cost, factories, environmental provision means IS 37, current liabilities, current assets, proceeds for the 5% loan notes means IFRS 9, deferred tax IS 12, interest payments, and suspense account. This is your prior assumed knowledge that the examiner expects you that you must know at this level the treatment of the suspense account. So this is your assumed knowledge. And when we go towards the attached notes for this question, the first note is related to IFRS 9 or financial instruments. The second note is related to non-current assets. You can see IS 16 can be examined in section A, B, and C. This is one of the most favorite standard of the exam. So note number 2 is related to IS 16, and note number 3 IS 37, and note number 4. There will be 4 notes in this question, and you need to, after day 2, you need to solve this question and send me the answer. And all of you are required to solve this question on the ACCA constructive response workspace. Then this is again the second assignment that you all need to submit till day 3. It has 7 adjustments. The first one is related to IFRS 15 revenue. The second one is related to IS 21 foreign currency. The third one is related to financial instruments. Fourth one IS 16 again. And you see a word revalue, it's head office. That means tangible non-current assets. Tangible non-current assets will be covered under the scope of IS 16. Then we have investment property, IS 40. Then there is an adjustment of IS 12. And this is again a assumed knowledge at F7 level that is related to rights shares. So right shares and bonus shares and suspense account. So these are the three basic topics, and in fact the depreciation, the calculation for the depreciation. These are the assumed knowledge for this paper, which is transferred from paper FA, financial accounting, paper F3. So these are the two questions and or assignments which we need to solve after day 2. And there are some students who still need this register, note down the question's name, or do you provide any document? For these two questions, I would recommend you to just note down the questions. These, the first one is related to September, December 2020 hybrid paper, and second one is related to March, June 2019. These both are related to the final accounts, well known. You can find easily these questions from the past papers, well known. And the second one is Loudon. So the requirement is to prepare the adjusted retained earnings, and second requirement is to prepare the balance sheet. For March June hybrid paper, the first requirement is to prepare the profit and loss, and the second requirement is to calculate the earnings per share according to the provisions of IAS 33. So these are some resources that we need to focus on. So we are going to start the session. So I want all of you guys to please do concentrate on the session and focusing on the key concept which I'm going to discuss with you. And when I give you a question, try to attempt it and write your answer on the chat box. And if you have any problem in attempting the question, or you wanted to ask any concept related to the standard, you can just write your question on the chat box. So let's start the session. IS 16 is all about the property, plant, and equipment. This standard is related to tangible non-current assets. Tangible non-current assets which we use into the business. Okay, tangible non-current assets. So when we talk about the tangible non-current assets, it should be dealt with under the scope of IS 16. The first portion is related to the cost, what we need to capitalize when we acquire an asset. That should include cost of purchase, then we have directly attributable cost, that is the cost that we need to incur in order to get the asset ready for use. And the third one is initial estimates of dismantling and site restoration cost. So these are the three types of costs that we usually capitalize. We can also capitalize the borrowing cost if IS 23 allows. Borrowing cost means interest on the loan, which could be capitalized, but it should be in accordance with the provisions of IS 23. We'll discuss this point later on when we are solving the question. Dismantling and site restoration cost is the future cost which you need to record it at the present value of the future cash flow. So how we calculate the present value? The formula will be future value into 1 plus I raised to the power minus n. This is the formula for the simple compound interest rate. Okay. And the second point that you need to remember is for the subsequent measure. Initially, assets should be recognized at cost. That includes all these components. And for subsequent measurement, we have got the cost model and the revaluation model. Cost model is related to the historical cost convention, and revaluation model means that you need to report the asset at the market values of that. So under cost model, we usually report the asset at cost less accumulated depreciation and accumulated impairment loss. But for the revaluation model, you need to take the revalued amount, that is the market value, less subsequent depreciation and impairment loss. So these two models are different. You have the option, you can select even the cost model or the revaluation model for the first time. But if you select a particular model, then it should be followed on a regular basis. So what about the revaluation model? There must be revaluation on the regular basis. When you do the revaluation, it should be for the same class of assets. Upward revaluation will go in the equity and downward revaluation will go in the income statement. Upward revaluation will go in the equity. Whenever there is something reported in the equity directly, it should also be reported in other comprehensive income. So I want all of you guys to just write down the accounting entry that we made after revaluing the asset. I'm just giving you a question. But suppose we have got a land having a value of 6 million, and after revaluation it will go on 10 million, and after subsequent revalue it will go on 2 million. So I want all of you guys to do the revaluation when the land goes from 6 million to 10 million and from 10 million to 2 million. Okay, there's a question that what's the difference between the revaluation and the fair value? When you see a fair value model in a particular accounting standard, that it means that you need to do the fair valuation adjustment on annual basis. But revaluation can be done on annual basis, or it can be done at more than 1 year. Like suppose you have got the policy to revalue after 4 years. So you can revalue the non-current assets after 3 years or 4 years or 5 years. It all depends on the policy. But whenever you see a fair value model, that means that you need to do the fair valuation adjustment on regular basis. That means it should be on annual basis. So very few students are responding. I request all of you guys to please do try to attempt this point I have shared with you. Like if the land goes from 6 million to 10 million, the accounting entry should be land debit 4 million, revaluation reserve credit by 4 million. Now from the exam point of view, you need to think like this, that if there is a revaluation gain which we have reported in revaluation reserve, then it should also go in other comprehensive income. The first thing that comes into your mind should be OCI, because when there's a gain that lands directly into the equity, IS1 says it should also be reported in the OCI. And the second thing is you need to book a deferred tax liability on this gain. So definitely if the company has earned a gain, then definitely there will be a portion that you need to pay to the taxation authorities. So there will be a tax consequences of this gain. So whenever you see a revaluation gain, there must be 2 points that should come in your mind. The first thing should be the revaluation reserve gain should also be reported in the OCI, and there must be a tax consequences, which must be deferred tax liability for the state. Okay. What about the second accounting entry? When this land goes from 10 million to 2 million, so there will be a revaluation loss of 8 million. Previously, I've got revaluation, 4 million. Now it's a revaluation loss of 8 million. So first, you need to reverse the revaluation gain that you have previously recognized, that is 4 million. An asset will be credited by 8 million. So the difference of this loss will be recognized in the income statement. So what's the whole concept? The concept is revaluation loss should be first recognized against the revaluation surplus, and the excess loss will go in the income statement. This is not a loss on disposal. This is loss due to downward revaluation. Now, one more question for you guys. Land having a value of 10 million. After first time revaluation, it will go on 4 million. And then it will, in the second revaluation, it will go on 12 million. Can you make the accounting entries? Relevant accounting entries for this. Please just write in the chat box. Initially, there is a revaluation loss of 6 million. Now, initially, there is a revaluation loss of 6 million from 10 million to 4 million. The accounting entry will be income statement debit and asset credit by 6 million. And subsequently, you can see there is a revaluation gain of 8 million. So the first thing that you need to do is to reverse the income statement previous loss by crediting the income statement by 6 million, and the excess gain will go in the revaluation surplus, which is 2 million. An asset will be debited by 8 million. Asset will be debited by 8 million. So this 2 million will be also be reported in OCI. First point, there must be a deferred tax consequences for this 2 million. Is that clear? It's good to see that people are giving the right answers. That's interesting. Can you repeat once more? Okay. In the first transaction, there will be a revaluation loss of 6 million from 10 million to 4 million. So if we bought a land for 10 million and after the first revaluation, we come to know that its value is now 4 million. So there will be a revaluation loss of 6 million. It will be reported in the income statement. And after some time, when we do the second revaluation, we come to know that the value of this land has increased from 4 million to 12 million. So there is now a revaluation gain of 8 million. So first, you need to reverse the previous loss that you have recognized in the income statement by crediting the income statement by 6 million, and the excess loss of 2 million, excess gain of 2 million will be recognized in revaluation surplus. Revaluation surplus is an account for actually for the balance sheet. But whatever we have in the revaluation surplus should not be reported in the OCI. Only the portion of the gain that we have recognized in the current year. Only the portion of the gain that we have recognized in the current year will go in the OCI section. Deferred tax part is actually the effect of deferred tax. We need to book a revaluation gain. We need to book a deferred tax liability on the gains. So whenever you have got some gain, there will be a percentage of the tax on that gain that you need to pay to the government. So if you are enjoying a gain, that there must be some portion that you need to pay to the government, that is deferred tax liability. Will they ask the general entries in the examination? No, they are not going to ask, but these general entries are important to understand the basic concepts. This we only do in case of profit in the first place. Yes, if there is a gain in the equity, then it will be reported in the equity section. But if there's a loss at the first time, then it will be reported in the P&L. My question is reaching to. Is my question reaching to teacher? Actually, a lot of students are asking at the same time. So I'm giving the answers on my pace. In this chat box to answer, or is this the chat box to answer? Yes, chat box. Uh, whatever communication that we are making right now is through this chat box. Revaluation will go in the equity. Netting of the revaluation, yes. Netting of the revaluation between the gain and the deferred tax will go in the equity. The entry from 10 million to 20 million in the last example. 10 million to 20 million. So if there is a gain from 10 million to 20 million, accounting entry to the asset debit and revaluation surplus bill. Was said that it will also be, yeah, deferred tax will also go in the okay. Income statement and SOP are the same. Yes. Statement of profit and loss and income statement is same. We have to deduct the effect of the DTL after revaluation from the SOPL. Yes, exactly. The number of share does not give me the option to do it. Can you speak louder? Yeah, I can speak louder than anyone else. How are 2 million? Number, do we recognize the deferred tax? Yeah, when there's a downward revaluation, there must be a concept of the deferred tax asset, but this concept will be examined by the examiner in SBR at SBR level. So at this stage, they will only uh, ask you about the deferred tax liability from the upward revaluation. 2 million will go in the equity. Yes. Screen was frozen because I'm doing nothing actually. I'm just giving the answer of the student. 10 million to 2 million in the last example. PP debit 8 million further. So the students was asking that if I'm giving you one more question for your clarity along with the impact. Suppose if there is a land having a value of 10 million, this will go to 2 million first, and after some time it will go to 12 million. All of you are required to make the accounting entry for this. So first, there is a loss of 8 million from 10 million to 2 million. So the accounting entry will be income statement debit or SOPL debit by 8 million and land credit by 8 million. So whatever loss that we have made will be recognized in the income statement. And then subsequently, there will be an upward revaluation from 2 million to 12 million. So there is a gain of actually 10 million, which is more than the loss that we have previously booked. So what accounting entry that we need to make at this level is land debit by 10 million. Income statement should be credited by 8 million because it is the amount that we have previously recognized in income statement. So I'm just going to reverse the amount of the loss that we previously made. And the excess amount will be reported in the revaluation reserve, which is 2 million. Now, let's suppose if the tax rate is 10%, which will be given to you in the examination, assuming if the tax rate is 10%. So there must be a deferred tax consequences for this revaluation gain, which will be 2 million into 10%. So there will be a deferred tax liability of 0.2 million. Now, what accounting entry that you need to make at this level? The tax consequences will also go into the revaluation reserve. So accounting entry will be revaluation reserve debit by 0.2 million and land credit by 0.2 million. Sorry, revaluation reserve debit by 0.1 million and deferred tax liability debit by 0.2. So this portion will be netted off against the revaluation surplus when we prepare the balance sheet. I hope it's clear now. Is there any question that you wanted to ask? Please do ask it immediately. Don't need to worry about the deferred tax liability. Right now, we are focusing on IS 16. Whenever we discuss concept of deferred tax, it will be covered later on. But as you have asked already, so it's my duty to guide you about this one. Now just read this portion. This is one of the paper, one of the adjustment from the past paper. Please read this paragraph and make the accounting entries, relevant accounting entries. What if there is a deferred tax liability, but there is nothing mentioned about the revaluation and the deferred? In the examination, whenever you see a revaluation gain, then you must record a deferred tax liability. If the tax rate was given to you, you only have to ignore the deferred tax liability when the examiner does not give you the tax rate in the question, or it clearly states that ignore deferred tax. So if this says to you that ignore deferred tax, then you can ignore the deferred tax liability. Otherwise, so did you all have solved this portion? What's your opinion about this adjustment? Is it difficult to handle? Note number 4. Is it difficult to handle? I don't think so. So the examiner has given the adjustment in March, June 1919 hybrid paper. Note number 4. During the year, well-known company revalued its head office for the first time, resulting in an increase in the value by 12 million. At 31st December, applicable tax rate, deferred tax liability is 25%. So the accounting entry will be asset debit and revaluation reserve credit by 12 million. 12 million. And this 12 million will also be reported in the OCI. And as you see, there is a deferred tax liability, which will be calculated at 12 million into 25%. So it will be 3 million DTL. The accounting entry will be revaluation reserve debit and DTL credit by 3 million. I think it's more clear now. Let's move on. Now, for the revaluation questions, yeah, we can make the combined entry for this as well. Yeah, we can net it off the amount. If you guys want me to give you the combined impact, I can also show you the combined impact of this. The combined entry will be, this will be the combined entry for this. Asset will be debited by 12 million. Deferred tax liability will be credited by 3 million. And revaluation reserve will be credited by 9 million, which will be reported in OCI. No, this 3,000 is not going to be added in the current tax expense because we didn't use the word income statement in the whole accounting entries. So the impact of the deferred tax because of the revaluation will go in the revaluation reserve rather than income statement. This has nothing to do with the income statement expense. This is the combined entry of these two entries. So the net impact that will go in the OCI will be 9 million. So right now, please do not discuss further about the deferred tax liability because we have a second day for dealing with the deferred tax liability. Right now, my focus is on IS 16 and our attention is diverting towards IS 12. DTL will be our non-current liability, yes. So I need to keep my focus on I-16 right now. Now, in the examination, you will be given a question in which uh, you have to do the working on the revaluation area, which is one of the favorite area of the examiner. Should be asked in section A, B, and C. So first, you need to see that whether the revaluation was done at the start or at the mid of the year or at the end of the year. So at whatever date the revaluation was done, first you need to calculate the net book value at that point. Suppose the question has asked you to do the revaluation at the start of the year. So first you need to have a net book value at the start. If it's mentioned the revaluation was done at the mid of the year, then you need to calculate the net book value at the mid of the year. So first of all, you need to calculate the net book value, assuming which is 10 million. Then this 10 million will be compared with the market value, which is assuming it's 15 million. So there will be a revaluation gain of 5 million. This revaluation gain into tax rate will become the deferred tax liability. This is requirement number 6. After doing the revaluation, now the subsequent depreciation will be the revised depreciation, which will be based on this 15 million divided by remaining useful life. So you need to see after the revaluation what is the remaining useful life of this asset, and then you need to calculate the revised depreciation. Sometime examiner might ask you to transfer the excess depreciation. The accounting entry for this will be revaluation reserve debit and retained earnings credit. Revaluation reserve debit and retained earnings credit for the excess depreciation only when the question will tell you that there is a policy of transferring the value from the revaluation reserve to the retained earnings. And how we can calculate this excess depreciation? Excess depreciation means the difference between the new depreciation and the old depreciation that we are charging. This is called excess depreciation. So these are the 6 steps that you need to understand when there is a concept of revaluation at the start or revaluation was done at the mid of the year. The difference will be the total depreciation or the monthly basis. It depends. It depends uh, on the policy that will be given in the question. Okay, so let's memorize all these steps. So first of all, you need to calculate the net book value at the time of revaluation, then compare it with the market value. There might be revaluation gain or loss. If there is a revaluation gain, then there must be a deferred tax impact. Then you need to calculate the revised depreciation and excess depreciation if there is a policy and deferred tax impact. So now here is an exam question for you guys. I want all of you to just attempt this part related to the lease property only. Only focus on lease property right now. You have been given a data and assuming it's a MCQs in which you are required to calculate all these 5 steps. These are the 5 steps that you need to work on. If there is a mid revaluation, yes, because for the first 6 months you need to calculate the revaluation on the previous values, and for the last 6 months you need to calculate the revaluation on the revised value. So now here's a question for you guys. First, read the question and identify at what time point of time, the company has done the revaluation. Okay, I have made the second group for this session. The group one is full now. So if you have got any student who have not yet joined the group, so the management will share the link of the group two. You can join the second group for this paper because WhatsApp only allows 257 contacts and it's full now. So I have just make the second group. So management is going to share with you guys the link for the group two. Please do join this group. Thank you so much. Students who have not yet joined, please do. So let's solve the question. Now, you can see here on the screen the year end of the company is 31st March 2006. And we have been given the cost of the lease property is 75,000 and its accumulated depreciation at the start of the period is 15,000. But the revaluation was done at the mid of the year. So first you need to calculate the net book value. So net book value at the start of the year is 75 minus 15,000. So it will be 60,000 at the start of the year. first you need to charge depreciation for the first 6 months in order to calculate the net book value. In order to calculate the net book value, so the amount will be 60,000 into 15%. So it will be 9,000 for the whole year. It will be 9,000 for the whole year, and for the first 6 months, the amount should be 4,500. So the net book value at the mid of the year will be 58,000, will be 60,000, 60,000 minus 4,500, so it will be 55,500. Lease property, oh sorry, we have done a mistake. Sorry. We have done a mistake actually. The lease property will be depreciated on straight line basis, and the plant and equipment is depreciated 15%. So right now we are discussing the lease property, so it should be depreciated at 25 years. So extremely sorry for this, I have done a mistake for the calculation. So the amount will be 60,000 divided by 75,000, divided by 25. So 3,000 for a year and 1,500 for the first 6 months. So the net book value at the start of at the mid of the year will be 58,500. So now we need to compare this book value with the market value of the asset, which is now 66,300. So there will be a revaluation gain of 66,300 minus 58,500. There will be a revaluation gain of 7,800. So the first thing that comes in your mind should be, do we need to calculate the deferred tax liability? The answer is yes. However, the revaluation will give rise to deferred tax. So if the question mentions you to ignore deferred tax, then you have to ignore the deferred tax. Otherwise, if there is a tax rate given in the question, then you need to calculate the deferred tax liability. So deferred tax liability will be calculated as 7,800 into 20%. The amount will be 1,560. Now, if you have any confusion in this part, please do ask it immediately. If you have any confusion, so I'm using this format. Now, the book value is 58,500. The market value is 66,300. So there will be a revaluation gain of 7,800, which will go in OCI, and the tax impact of this will be 1,560. How we can calculate this figure? 7,800 into 20%. Now, what about the excess depreciation? Do we need to adjust the excess depreciation? Now, it's clearly mentioned here that Triage does not make an annual transfer from the revaluation surplus to the retained earnings. So that means there is no need to adjust the excess depreciation in this question. Now, what about the revised depreciation? Now we are going to calculate the revised depreciation. 66,300 divided by the remaining life. Now, what remaining life we need to use? The remaining life will be 19.5. So when we divide this figure by 19.5, we got the value of 3,400 for the whole year, and for the last 6 months it will be 1,700. So now what will go in the income statement? In the income statement, we will charge a depreciation of 1,500 for the first 6 months and 1,700 for the last 6 months. What will go in the OCI? In the OCI, there will be a 7,800 reported gain less tax impact of 1,560. What will go in the face of the balance sheet in the asset section? Asset side 66,300 minus subsequent depreciation of 1,700. This is the net book value that will need to report on the balance sheet. Wonderful. Now the question is how 19.5? Now for this you need to go back. Now when we do the calculation on straight line basis, the cost depreciation will be calculated as a cost less scrap value. The cost is 75,000. We don't have any scrap value here. The cost divided by useful life, which is 25 years. So the annual depreciation that we are charging is 3,000. So in the accumulated depreciation, if there is a revaluation, there is an accumulated depreciation of 15,000. That means that we have already charged 5 years depreciation. When we divide 15,000 by annual depreciation, which is 3,000, the answer will be 5 years. So at the start of this year, my asset was already 5 years depreciated. And then I have charged a depreciation for the first 6 months, which is 1,500. So at the time of revaluation, I have already depreciated 5.5 years out of 25 years. So what will be remaining useful life? The remaining useful life will be 25 years minus 5.5. The amount will be 19.5. Is it clear? Wonderful. Now in the examination, there might be the question to that the examiner might ask you is what in which the revaluation will be given to you at the end of the period. So how we can identify this? The fair value will be given at the end of the year. Then this will be the question of the revaluation attempt, in which you are only required to do 4 steps. The first thing will be you need to calculate the net book value at the end of the year and compare it with the market value. Then there will be a revaluation gain or loss, and you only need to calculate the deferred tax liability if there is a revaluation gain. That's it. Because we have done the revaluation at the end of the period, so there is no need to calculate the revised depreciation. In this question, we don't need to calculate the revised depreciation. Only 4 steps are required. DTL and RR would have the same value. No, RR will be having a different value because it also includes the gain of 7,800. Now, again, just read the question and try to identify whether the revaluation was done at the start or at the mid of the or at the end of the year. And then solve this question. You have only 2 minutes, 1 minute in fact, to solve this one. Solve it. Please try to solve it. Yes, is it done? Now this question is about the revaluation was done at the end of the year because the year end is 30th September and the market value is now 41.8 million. So we have got the land having a value of 7,000 and building having a value of 36,000. So first of all, you need to charge a depreciation. Land is not depreciated. So the book value will be 7,000, it will remain the same. But for the building, you need to charge a depreciation for the whole year. So what is the depreciation expense for the building? Very good. It will be 2,000 for the year. The book value is now 34,000. So the land and building in totality will be having a value of 41,000. The market value is now 41,800. So there will be a revaluation gain of 800, which must be reported. Now, this question tells you clearly that ignore deferred tax. So you can ignore the deferred tax because it's the requirement of the question. And this 800 will be reported in the OCI. And that's it. So in the income statement, the depreciation that we will charge will be 2,000. In the OCI, there will be a revaluation gain of 800. And on the face of the balance sheet, now asset will be reported at 41,800. That's it. That's the point. No, because we haven't charged the depreciation from 1st October till today. So it means that 18 years is still left. Revaluation reserve, in the revaluation reserve equity side, it will be reported at 800. Is it clear? Now here is a recent exam question for all of you guys in which you are required to solve this question. We'll be having two assets. The first one is office building at cost and factory at cost. We have got two assets and the year end is 30th September 2008. This is the question which will be examined in the recent past paper for December 2020. So this is the recent past paper question. So if you will be able to attempt this one, then definitely you will be in a position to solve the question in the examination. So I want you guys to, I'm giving you just 2 minutes, solve this. Please read the question. Because after the revaluation, we ignore the previous depreciations when we are reporting on the face of the balance sheet. So whenever do we do the revaluation, then asset will be considered as a new one and we always ignore the previous depreciation. So only the subsequent depreciation will be deducted. I hope it's clear. Please do solve this question. You have 1 minute for this one. The time management should be accurate. Read the question carefully. And there is also a question from the system account as well, embedded in this question. The time is over now. It should be done. Okay. Office building cost 20,000 and accumulated depreciation of 4,000. Allowed on company acquire an office building on 1st October 20x2. Okay. 20 million with an estimated useful life of 25 years. Depreciation is charged on a pro rata basis. Okay. On 1st April 2008, the building was deemed to be impaired, and as its fair value was estimated as to be 12 million. That date, the estimated remaining useful life was revised to 12 years. Ignore deferred tax consequence. First thing that you need to understand is that you have to ignore Gordon had 10 factories. Now, this is a separate area that is related to the factories. Right now, we are working on the office building. Okay. So, if this year ends on 30th September 2008, it will start on 1st October 20x7. And we have done the revaluation on 1st April. Means October, November, December, January, February, March. So, after 6 months, we have done the revaluation. So 20 million divided by 25 years will give you a depreciation for 1 year. 20,000 divided by 25 years. It will be 800 for the whole year and 400 for the first 6 months. So the net book value at the time of the revaluation will be 20,000 minus 4,000, that is the previous equivalent depreciation, minus current year's depreciation is 400. So the net book value should be at the time of revaluation that will be 15,600, and the market value is now 12,000. There will be a revaluation loss of 3,600. So as you know, there is a loss, then this loss should be reported in the statement of profit and loss, SOPL, or income statement. Very good. Now, what about the revised depreciation for the last 6 months? The revised depreciation should be based on now 12,000. The remaining life is now 12 years. So annually, we need to charge depreciation of 1,000. And for the last 6 months, it will be 500. I hope it's clear now. So this was the question which was examined or which was asked by the examiner in December 2020 session. In the final account, this is one of the adjustment of the final account, and I think it's quite easy. So if you remain cool and calm and have got practice of the key concepts, then definitely this paper will be just a peanut for you. Now let's move on towards the factory. That's moving towards the factory area. Now, what says about the factory? Loudon Company had 10 factories. On 1st October 2007, means at the start of the year, Loudon sold one of its factories with a carrying amount of 3 million, cost 5 million, accumulated depreciation 2 million for 3.5 million. So the accounting entry should be cash debit and disposal account credit, 3,500. But what they have done, they recorded the proceeds by debiting the cash, but they made the credit entry in the suspense account. So what they have done, the accounting entry is 3,500 cash debit, and suspense account credit by 3,500. So this is what they have done. So all you need to do is to make the correct accounting entry, and there will be no suspense account after the correction. There could be a combined entry for this transaction, which could be cash debit 3,500, asset credit by 3 million, and gain in the income statement will be credited by 500. This could be the accounting entry. And what they have done, they have recorded the whole amount in the cash account and credited the suspense account. So all you need to do is to correct this transaction by debiting the suspense account and crediting the value of asset and income stream. So the first thing is to remove the suspense account impact, and the second thing is to calculate the depreciation. So you only need to understand this, that whenever you are doing the calculation for the depreciation, you have to deduct the asset or the factory that we have sold at the start of the year. So after deducting the factory that we have sold, like the factory has having a cost of 40,000, we have sold 5,000 cost of the asset. So the remaining cost of the factory is now 35,000. And accumulated depreciation, previously I've got an accumulated depreciation of 2 million, sorry, accumulated depreciation of 11,100. We have sold the accumulated depreciation of 2,000. So 11,100 minus 2,000, it will be 9,000. So the net book value will be 35,000 minus 9,100. So simply you have to remove the impact of the asset that we have sold, and then you need to charge depreciation, which is 15% per annum on reducing. The depreciation will be 15% of this value. 25,900 into 15%, it will be 3,885. But you need to remember this point, that whenever you are going to prepare the income statement, there will be a depreciation of 3,885 for the factories, as well as there is a gain of 500, which also will be reported in the income statement. What we do, what is suspense account? What do we have to keep in mind? Whenever you see a suspense account in a particular question, that means that we an accountant, we have to think like that there must be an error in the books of accounts. So there must be some errors at the time of the recording or at the time of the posting, which imbalance the trial balance, and the suspense account goes open. Okay, depreciation again. I have done nothing, just remove the asset 5,000 cost and accumulated emission from the relevant accounts, because we have sold this factory at the start of the year. So I have just removed the impact from the total values, and on this net book value we are going to charge 15%, because the method is reducing balance. So whenever we have got the reducing balance method, and depreciation will be charged on the net book value. So I've just taken 15% of 25,900. We got the value of depreciation, which is 3,885. Gain of 500. Do remember this point. The gain that we have recognized, that we have earned or realized, should not go in the OCI. In the OCI, then at your level there will be only revaluation gains, because these are unrealized gains. So unrealized gains can be reported in the OCI, but the realized gains will go in the P&L. When you explain about the suspense account means an account which was open in the books of accounts when the trial balance was imbalanced, and which shows that there must be some errors in the books of accounts. Then you need to correct these errors, and there will be no suspense account after correction. Yes, it could be transferred, it could be recognized as a gain or other income in the income statement, or it could be adjusted against the depreciation. Moving on towards the next slide. Now here we have got a question for you guys. I want all of you to just read the question, and this is the requirement. For the year ended 31st March 2008, how much should be capitalized in respect of the construction of the extension of the head office building? So out of this total figures, what amount we need to capitalize in order to calculate the cost of that? Just read the question. So you have 30 seconds for this question. I have made the second WhatsApp group. So those students who have not yet joined the group, I recommend you guys please click on the link shared by the management on the chat box. And I also request the management to please share the link of the WhatsApp group, second WhatsApp group that I have made. If there is a problem faced by any individual, you can WhatsApp me on my number. So after this session, I will add you guys on the group 2. So the right answer for this question will be 18.4. The right answer for this question will be 18.4. Okay, ji. So we are going to read the requirement first. How much should be capitalized in respect of the construction of the extension of the head office? So actually, the company is extended its head office building. So we need to capitalize. We need to add all the figures which is relevant according to the IS 16. So this amount should be capitalized. Land acquisition, fee for the environmental certification and building permits. That's important for us. Architects and engineers fees should be capitalized. Definitely, we need to capitalize the cost of the construction material and labor costs. And in the data, it was given the date when the head office extension became available for use. And that means that when the building was completed, there was also some unused material. So unused material should be deducted from this amount. So net amount should be capitalized. So because the material that was left over will be used for the next construction, so it should be deducted. At that date, the total borrowing cost incurred on the loan. The borrowing cost means that is the requirement of IS 23. IS 23 allows you can capitalize interest cost only when the construction was in progress. At that date, the total borrowing cost incurred on the loan, which was used specifically to finance that office, extension to 0.8 million. So 0.8 million will also be capitalized. So when you add all these figures and deduct 0.5 million, the answer will be 18.4 million. Very good. Yes, you are sending the questions to the right forum. The answer is right, 18.4 million. But if the borrowing cost was not specifically to finance the office building, then it will not going to be capitalized. Now, two more theoretical questions for you. This one and this one. Just read these questions and give your answers in 30 seconds. 30 seconds, 2 minutes. Yes, we can apportion or proportionate the borrowing cost only when it was mentioned that the construction was done, like for example, in 7 months or 8 months or 9 months. So if the time period was mentioned, then we need to capitalize only the amount of the interest that is related to the time period in which the construction is in progress. Very good. The right answer for question number 1 is B. So this is again one of the questions from the past paper. So if your concepts are clear, then the paper will be very easy for you to attempt this my recommendation to all the students: do not panic in the examination. We remain cool and calm and focus on the concepts. Then this is one of the high scoring paper of skills module. Now, what about the last question? Is it A, B, C, D? Which of the following statements is false? Now, what about statement A? These questions are very important for concepts building. Like if you are thinking that A is not a right answer, that it means that this statement is true. So you should know this whether this statement is true or false. In subsequent years, the depreciation will be based on the revalued amount of the head office building as opposed to its cost. Is it true or false? It's true. Because after the revaluation, we take the revalued amount and revise depreciation, and revise useful life for subsequent depreciation. Any revaluation gain on the head office building is recognized in other comprehensive income, and any revaluation loss is recognized in statement profit loss. Is it true or false? Very good, it's true. Because all gains are recognized in OCI and losses will go in the income statement. Each component part of the head office building is revalued separately. We never do this according to the provision of IS 16, because IS 16 says once the asset is going to revalue, you have to do the revaluation at the same time for the whole class of assets. So the whole class of the asset should be revalued at the same time. So each component part of the head office building is revalued separately. So it will be wrong. The next one is the residual value and the remaining useful life of the head office must be reviewed annually. Yeah, this point is actually connected with IS 8, which says that all accounting estimates should be reviewed annually. All accounting estimates should be reviewed annually, and if there is a change, then it should be dealt with prospectively. So there are, according to IS 8, there are two approaches. The first one is retrospective and the second one is prospective. So we change the residual value and the useful life prospectively, like we deal the accounting estimates prospectively, but the accounting policies and errors or frauds should be corrected retrospectively. These are the points of IS 8 which we will discuss. I think we need to take a break of 5 minutes. Yeah, option C will be related to complex assets. That if we have got the assets having significant components, having different useful life, then each significant component should be depreciated separately. So it's about the depreciation, it's not about the revaluation. Okay, I have discussed this point that all estimates, according to ISA, all estimates should be accounted for prospectively, and policies and correction of errors or fraud must be dealt with retrospectively. So let's take a 5 minutes break. It's just a water break or 5 minutes tea break. Don't go anywhere. I'll be there after 5 minutes. I request the management again to please share my contact number and the link of the group too in the WhatsApp so that we can add all the students in our WhatsApp group and we'll discuss the concepts over there. So I'll be there after 5 minutes. I'll be back after 5 minutes and we will give the answers of some of the students. Isma, you have to wait for 5 minutes for your answer. Okay, welcome back again after the break. So let's start the session again. Let's resume the session, in fact. So this is about IS 2 inventories. IS 2 says that the inventory should be valued at the lower of cost and net realizable value. Net realizable value is the estimated selling price less expected cost to sell. And cost includes the cost of purchase, cost of conversion, like from material to finished goods, and other costs in bringing the inventory to its present location and condition. So these are the three costs that we need to add it in the cost of the inventory, and then we need to calculate the net realizable value, and inventory should be reported at the lower of, whichever is lower should be used for the calculation of the inventory. Okay, well, one of the student has asked about the concept prospectively. Prospective means that you need to do the adjustments in the current and future years. Retrospective means you need to do the adjustment in the previous years. So the change, prospective means the change should be applied from the date of the change, and retrospective means the change should be applied from some previous date. So that's the basic difference between prospective and retrospective. So according to IS2, inventory should be valued at the lower of cost or net realizable value. Cost includes cost of purchase, cost of conversion, and other costs. NRV will be calculated at estimated selling price less estimated cost of completion and cost of disposal. These two costs will be deducted in order to calculate the net realizable value. And then inventories will be reported at whichever is lower. Now, for the cost formulas, you can use first in, first out, that is FIFO. LIFO is no longer allowed under IS2. You can use the policy as average cost, that is called weighted average, and actual unit cost. So these two are actually accounting policies. If you wanted to switch from FIFO to weighted average or weighted average to FIFO, then it means that you are going to change your policy. And whenever we do a change in the accounting policy, it should be accounted for under IASA. Change in accounting policy should be applied as retrospectively under ISA. So again, I'm repeating this point. Whenever there is a change in estimate, then it will be applied prospectively. But when there is a change in policy, then it will be applied retrospectively. So here's a quick question for you guys. You have 30 seconds to solve this one. This is again one of the unanswered question from the recent past paper. So what is the right answer for this? So we have been given inventory with a value of 8.6 million. Inventory count was completed on 31st December 2008, but two issues have been noted. First, product will be the sale value of 0.6 million had been incorrectly excluded from the inventory count. So one of the inventory having a sale value of 0.6 million is excluded from the inventory count. Second item is costing 0.2 million. The second item is having a cost of 0.2 million, which had been included in inventory count, was damaged and could only be sold for 50% of the normal selling price. And theirs makes a markup of 50% of both of these items. So all you need to do is to calculate the net realizable value for this part, and for this part you need to calculate the cost. So if the cost is if the selling price is 0.6 million and there is a markup means cost plus 50%, then therefore the sale value should be 150%. So the cost will be 0.4 million for this one. Is it clear to all of you? Similarly, if the cost price is 0.2 million, then based on the normal selling position, its selling price should be 0.3 million. But now this will be sold at their 50% of the normal selling price. So 50% of the normal selling price will be 0.15 million. So now it's a time to identify at which amount this inventory item should be reported. So as the IS2 says, that should be reported at the lower of cost and net realizable value. So the lower value is 0.4 million. So we need to add 0.4 million in it because it's excluded from the inventory count. And for this portion, it should be reported at the lower value, which is 0.15. But this part of the stock is already included at 0.2 million. So actually, there will be an adjustment from 0.2 million to 0.15 million. There will be an adjustment of 0.05. So first of all, you need to add 8.6 million plus 0.4 minus 0.05. So the amount answer will be 8.95. Is it clear to all of you? Again, first read this point that inventory cost 0.2 million, which has been included in the inventory count, were damaged, which has been included in the inventory count were damaged and could only be sold at 50% of the normal selling price. So first of all, you need to calculate the normal selling price. The cost plus profit is equals to sales value, right? The cost is 100%, the profit is 50%, the sales value should be 150%. So we have been given a cost of 0.2 million. So if you divide 0.2 million by 100% and multiply it by 150, we got the value of sales, which is 0.3 million. So if the cost price is 0.2 and the selling price, and which is the normal selling price, is 0.3 million, and question says that as the goods are damaged, it could be sold at 50% of the normal selling price. So when we take the 50% value of 0.3, it will become 0.15. The cost is 0.2, NRV is 0.15. It should be measured at 0.15. Is it clear? So the answer is 8.95. So as you can see that mostly the people took the IS2 as a taken for granted, but examiner can ask you some challenging questions from this. Yeah, 0.05 is the NRV adjustment from the 0.2 million to 0.15 because the inventory is already included at a price of 0.2 and we have to make it at 0.15, so there will be an adjustment of 0.05. Yeah, these are the type of the question which the examiner asked. This is again a type of the question which was examined in a recent past paper. This was examined in December 2020 question. Please read this question and write your answer in the chat box. You have 30 seconds for this question as well. It's very good to see that the people in the group are helping other students. So I recommend all the students who got the concepts uh, clear from these slides are requested to help those who didn't get the concept clearly. So there are people who are messaging me on continuous basis, but I will not be able to reply right now. So I will add all of you guys in group 2 because the group 1 is complete now. So now I will add all of you guys in group 2. So the right answer for this question is A. Is it clear? Because when you do the calculation, the cost of this inventory is 14,900, but its NRV will be 14,968. So we need to report the inventory at the lower of cost and neutralizable value, which is 14,900. I hope it's clear now. $13 per unit is the estimated cost to complete, and 2% will be the estimated cost of disposal. WIP is not included actually. Whenever we are going to calculate, when we are going to report the inventory, we have to calculate its cost, which is the cost that we have incurred up till now, and the net realizable value. The formula for the net realizable value is actually based on the future values. The estimated selling price that we are expecting that this inventory will be sold at this price minus estimated cost of completion. How much cost that we need to incur in the future. So all future related costs will be adjusted in NRV. And estimated cost of disposal. How much cost do we need to incur in order to dispose of the inventory. So these are the all costs which should be included in NRV. In a very simple terms, NRV can be defined as the net amount that you will get at the time of disposal. So the students want me to solve this point. Now here the cost was given to you guys already, it's 14.9. Now in order to calculate the net realizable value, first you need to deduct, that's the estimated selling price. The cost of completion is 13 per unit. So on per unit basis, after deducting the cost of completion, the price will be 153. So this is the amount that we will realize after disposal. And there will be a 2% cost of disposal. 2% cost of disposal means 166 into 2%. So 2% point 2, that will be 3.32. So the net realizable value of each unit will be 153 minus 3.32. It will be 149.68. And we have got 100 units of inventory. By multiplying these two figures, we got the value of 149.68. I hope it's clear now. Work in progress. I didn't deduct the work in progress cost. It is actually the future estimated cost that we need to incur in order to bring the inventory to the saleable condition. So just remember this point, the cost that we have incurred till date should be included in the cost, and the cost that will be incurred in the future should be adjusted against the NRV. Do remember this concept. Okay. One more quick question for you guys. We have 2.1 and 2. Your answer should be in the form of A, B, C, D. Just give your answer. You have 10 seconds. Okay. In an attempt to improve the reporting profits, the director of the US company wants to change the valuation method from the FIFO to the weighted average. That means it's a change in policy. Which, if any of the following statements regarding the potential change of the in inventory valuation is or correct? The change represents a change in accounting estimate? No. The financial statements will be adjusted prospectively? No. Because change in accounting policy should be accounted for retrospectively. So now the right answer for this will be neither one or two. Very good. Now let's start the new standard, that is IS 20 government grant. Government grant means any type of government support that the government provides to the entity in the form of economic resources. So any type of help that the government provides to the entity in the form of economic resources is called government grant. It could be grant related to revenue and grant related to capital. Grant related to capital is also called grant related to assets. So if the government has issued you with a government grant to buy or manufacture a particular non-current asset, then it will be considered as a grant related to asset. But if the government has provided the grant for any other reason, then it will be considered as a grant related to revenue. Now, what are the treatments? Grant related to asset can be recognized as a deferred credit and then released into the income statement gradually. Or it could be netted off, deducted from the asset cost. So these are the two treatments of grant related to asset. Grant related to income can be recognized initially as a deferred income and then released in the income statement by netting off from the related expenses, or recognize the gross amount separately as another income. So these are the basic 2 points for government grant. Now, first we are going to discuss about the revenue grants. Revenue grants means the government is giving you the grant other than non-current assets, other than to acquire or to manufacture a non-current asset. If the government is giving you, we can say this, any type of grant which is not grant related to asset will be considered as a grant related to the revenue. That's the definition of IS 20. So let's discuss this point. An entity receives the government grant of 6 million on 1st January. 1st January, company has received the government grant of 6 million. So accounting entry will be cash debit and deferred income credit. This will be recognized as unearned income. On 1st January 2004, to keep the staff motivated within a deprived area, the grant was received to keep the staff employed. So to increase the employment, the company has issued a grant to the company. The company must not make redundancies. So if you think about the COVID situation, there are a lot of people who got redundant and lose their jobs because of this pandemic. The government has given them the cash to pay off their salaries and asked the companies not to expel any employee from the company for the next 3 years. Or the grant will be the grant is to be repaid in full. Like if the company has done some non-compliances from the agreement, then you have to pay the whole amount of the grant immediately in full. At 31st December, at the year end, no redundancy has taken place and none are planned. So out of this 6 million income, which is for the 3 years, 1 year is completed. So we have earned 1 year's grant, which should be 2 million. The accounting entry will be deferred income debit 6 divided by 3 will be 2. Deferred income debit or income statement credit will be 2 million. This treatment is called amortization. Releasing the grant in the income statement over the period called the amortization of the government grant, which will be recognized as an income. So this 2 million can be recognized as an income, or you can see the first slide as an income here, or it could be adjusted against the related expenses, like expense less income. So you can net it off this income with the related expenses, or you can recognize this income separately as other income. So these are the presentations for the revenue grant. I hope this is clear. How can we give back the whole amount? One, it is declared that the revenue grant to pay the part of the particular period. No, it's all about the agreement that you have made with the government, because the government, whenever government is supposed to support someone, so it actually work on the output. So if you will not be able to fulfill the output, which is the requirement is 3 years, which is the prime requirement, that you cannot expel any employee before 3 years. So if you do this, that means you are in the breach of the contract. So you need to pay the full amount. It all depends on the contract that we have made with the government. It might be the situation in which you only have to pay the remaining amount. What about the expenses that we are being charged for not creating redundancy? Expense will be the salary, wage and salary expense. So in order to support the wage and salary expense, the company is supporting you with a 2 million grant on an annual basis. Why does the government give the grant? Just to support the industries, just to help the industries. Grant between parent and subsidiary. Yeah, if the grant was given to the whole group, then it could be adjusted. We were taught that in the breach of the contract revenue grant, you should have to pay the amount of particular period. No, it's not like that. It's all about what IFRS says. IFRS says that in case of the repayment, which could be a partial or the full repayment, it all depends on the agreement. Who is giving you the grant? The government is giving the grant. So if the government is giving you the grant, then government can ask you for the whole amount, or it can ask you for the partial amount. It will be decided initially. So in this question, it's totally decided that you need to pay the full amount. Now, what amount is left over after the first year in the deferred income? In the deferred income account, out of 6 million, we have earned 2 million. So in the deferred income account, it's 4 million, which is remaining. Okay. Suppose at this point of time, company did the breach of the contract and you have to pay the whole amount of the grant in full. So what will be the accounting entries for the repayment of the government grant? What do you think should be the accounting entry for the repayment? Cash will be credited by 6 million. Deferred income will be debited by 4 million because it has a balance of 4 million. So the remaining difference, so the remaining difference of 2 million will go in the income statement. So this will be the accounting entry as an expense. Yes, this is an expense which will go in the income sheet. Very good. The question says that which two of the following correctly reflect the accounting treatment for the government grant that could be adopted by the Millhouse company in the statement of financial statement for the year end 31st December 2009. So please read this question and reply with your answer. Is a capital grant or a revenue grant? Is it a capital grant or the revenue grant? Now let's read the question. Millhouse company received a government grant on 1st October 2008. The grant was to help fund the rental cost of the factory in an urban regeneration area. Now, it's the government is giving you the rental actually, or you all knew that rental value is the cost, is an expense of the business. The government is supporting you in order to cover up your expenses. So this is not a capital grant. This is again a revenue grant situation because the government is not supporting you to buy a factory building or to manufacture a factory building. So you cannot record the non-current asset when you have an asset on a rental basis. Therefore, it's a revenue grant, first of all. The condition of the grant were that the factory must be rented and used for at least 1 year. Millhouse rented a factory from 1st July 2009 and was confident that the condition of the grant would be met. Millhouse owned other factories in different areas. Which two of the following correctly reflect the accounting treatment for the government grant that could be adopted by the Millhouse in its financial statements? Recognize the grant in full as other income in the statement of profit and loss. The first thing. Deduct the full amount of the government grant from the cost of the factories in the statement of financial position. Recognize 3 months grant of the grant income as other income statement profit and loss. Deduct the 3 months grant from the related factory expense. Full amount. So what should be the right answer for this? And do remember this, that examiner has asked you about the 2 options. So you have to select the 2 options because you have 2 treatments for the grant related to asset. So the right answer should be yes, C and D. But you have to be very confident when you are attempting the question that why A is wrong, B is wrong, and E is wrong. Because the year end of the company is 30th September and we have rented this factory on 1st July. So from July, August, September, so we have just used factory for the 3 months. So we can only recognize the income for the 3 months, which could be reported as an other income or it could be adjusted against the related expenses. We cannot adjust the full amount because the grant is for the 12 months period and we have only used 3 months expenses for the factory and deduct the full amount of the grant from the cost of the factory. This is the treatment of grant related to asset. That's why it's wrong. Full amount of grant from the factory rental expenses, you cannot recognize the full amount. So you knew from these questions that why if C and D is right, then why A, B, and E is wrong. Very good. Now capital grant. We will solve this question with the both methods. The first one is deferred credit and net off. So first we are treating it as a deferred income. So we have a deferred income of 45,000 government grant, and we have acquired a machinery at a value of 3 lakh. Please read the question carefully and try to solve it by yourself. So do remember this point because it was not discussed earlier. Do remember this point that whenever we have a grant related to asset, then the grant will be amortized in the income statement based on the method of depreciation. So if we are depreciating at 20% on straight line method, so 3 lakhs into 20% will be 60,000. Then the grant will be amortized in the same pattern. The amortization of the grant will be 9,000. So this is called deferred credit approach, where we need to recognize the depreciation and amortization separately. The condition of the grant was written in the previous question was the factory must be rented for at least 1 year, but only rented for 3 months. Yeah, till the reporting date we have just used the 3 months, but we didn't revoke the agreement. We didn't cancel the agreement. The agreement is still there. We will use for the remaining 9 months in the next year. So the part of the government grant for the next 9 months will be recognized in the next year. Deferred credit means that whatever grant that you have received should be recognized in the deferred income account. So you can see here that I have recognized the government grant in the deferred income account. Now the second treatment is whatever grant that you will receive, cash debit 45,000 should be adjusted against the cost of the asset. Asset will be credited by 45,000. In the previous situation, we make the accounting entry cash debit 45,000 and deferred income credit 45,000. So in this case, grant will be recognized as a deferred income, and in this situation, grant will be recognized in the value of the asset. So the net value of the machinery will be 3 lakh minus 45,000 after deducting the grant. The amount will be 2,55,000. 3 lakh minus 45 will get the value of 2,55,000. And when we charge a depreciation for this will be 2,55,000 into 20%. So once you calculate the depreciation at this amount, that is 255,000 into 20%, it will be 51,000. So if you adjust these two figures, the net amount that will be reported in the income statement will also be 51,000, because we have got the expense of 60,000 and an income of 9,000. So if we adjust these two figures, the net burden on the income statement will be 51,000. In both the approaches, the net burden on the income statement is same. Therefore, IAS 20 has allowed us to use either the net approach. Net approach means the grant will be credited in the value of asset, or deferred income approach. So 51 is the net expense after adjusting the government grant impact. All the slides, lecture slides, are available on the handout section. You can download all the slides, and after the class I will share all the slides and the related material on the WhatsApp group as well. So you do not need to take the screenshots of the questions, only focus on the solutions. Which is the income to be recognized? In the netted off situation, we do not need to record the income separately. The income is adjusted already in this 51,000. Only in the deferred credit approach, you need to record the expense and the income separately. So again, IAS 20 is one of the most important standard for this session. So we have covered IAS 16, IAS 2, and IAS 20. These all are important standards for this session. Now the next standard is IAS 38. IAS 38 is again one of the favorite standard of the examiner, because it is connected with IFRS 3, which is related to consolidation. And consolidation has one of the important component, which is goodwill, which is again an intangible asset. Goodwill is also an intangible asset, but goodwill should be accounted for under the provisions of IFRS 3. Now, what about intangible asset? What IAS 38 says about the intangible assets? IAS 38 says that if the company has acquired the intangible asset, means purchased, then you can recognize that intangible asset in the books of accounts. But if you have self-created the intangible assets, self-generated intangible assets are not allowed to record on the face of the balance sheet. Like if I have acquired the goodwill of a business and we have purchased that goodwill, then you can capitalize and record that goodwill on the face of the balance sheet. But if you have created the value of your goodwill internally, then you cannot recognize, according to IAS 38, that goodwill. So internally generated brands, internally generated goodwill, internally generated logos, they all are not allowed to record on the face of the balance sheet. Only purchased intangible assets can be recognized. Okay. The next topic is related to research and development. There is a clear difference between research and development. Research means you are just gaining a knowledge. You are just studying something. You are doing some work to gain the knowledge. So all research costs should be charged as an expense. But when you are developing something, that means that you are applying that knowledge. So development is all about the application that you are going to make something which could be a goods or services. It could be capitalized as an asset or it could be charged as an expense. So IS 38 clearly says in a very simple manner that if you are incurring the cost on the development and you knew it that this development is going to be completed in the near future and you will get the benefit from this development, then this cost can be capitalized. But if you knew that you will not going to continue that intangible asset or the development, or even if you have developed that product, then it will not give you that benefit that you are expecting, or it might be a loss making development, then the cost of the development will be recognized as an expense. So in a very simple terms, if you see that the expenditure is going to give you the benefit in the future, then this should be capitalized. And if the expenditure is not going to give you a benefit in the future, then it will be charged as an expense. That's a very simple concept. Amortization, all intangible assets must be amortized over its useful life. So all intangible assets having limited useful life must be amortized. Goodwill will never be amortized. It will be checked for the impairment on annual basis. Do remember this point, like land, we never do amortization of the goodwill. Neither we do any sort of revaluation in the goodwill. Goodwill will only be checked for the impairment annually. If there is a loss in the impairment, then you can recognize the loss. But you can never recognize again the value of the goodwill. Goodwill will be calculated as according to the provisions of IFRS 3, which is the value of the business less fair value of net assets. This is the formula for the goodwill. Value of the business less fair value of net assets. So the difference between the value of the business and the value of its fair value of net asset will be goodwill. If there is a positive goodwill, then it will be reported as a non-current asset. And if there is a negative goodwill, then it will be recognized as an income in the income statement. What about the indefinite life for amortization? We will never do the amortization for the assets having indefinite useful life. They all will be checked for the impairment on an annual basis. Can we recognize a purchase customer list? Yes, you can recognize a purchase customer list, but only if it meets the criteria of intangible asset. Initially, it should be measured at the cost, and subsequently we have two models. Like we have studied IS 16, it can be measured at the cost model or the revaluation model, but usually intangible assets are measured at the cost model because there is a condition under IS 38 is that you can only use the revaluation model when there is an active market of that asset. Then you can use the revaluation model. So if there is no active market for an intangible asset, then you cannot use the revaluation model. So usually intangible assets are measured at the cost model. The treatment is very much similar to IS 16. Negative would be recognized in the income statement as an income. Subsidiaries' internal goodwill can never be recognized on the face of the balance sheet of subsidiary company. You can only recognize the goodwill of the subsidiary company if the parent has acquired subsidiary company. Please explain the criteria for the intangible asset. The criteria, do not go into the more details about the criteria. The criteria is very simple. You only think about the expenditure, that if you are incurring an expenditure, do we get the benefit from that expenditure in the future or not? If you are going to get the benefit of these expenditure in the future, then it could be capitalized. Otherwise, it could be charged as an expense. Negative goodwill is also called gain from bargain purchase, which will be recognized as a income. What about the purchase research? Purchase research can be capitalized. Purchase research can be capitalized because if you are purchasing a research of someone, that means this is a useful research and it will going to give you the benefit in the future, then you can capitalize. Goodwill and active market relation. There is no relationship of goodwill and its active market. Active market means that assuming there is a accounting software, as you all know that softwares are intangible assets. So one of the famous software around the globe is SAP, SAP. So SAP is one of the software that is mostly used in different top level companies. So if you have got installed or acquired the SAP, then you can have the active market of that SAP from the market. But the goodwill, do remember this point, the goodwill is a unique thing. It's like your face value. Your face is unique, your beauty, your appearance is unique, that you cannot compare yourself with any other. And that's one of the reasons that we cannot measure the human being in terms of money. Talk about the steps in negative goodwill. If you got the negative goodwill, simply it will be recognized as an income in the income statement. This will be discussed later on when we are covering the topic consolidation. So let's move on towards this question. Please do attempt this question. You have 1 minute. Yes, is it done? So Moston commenced a research and development project on 1st January 2005. It spends 1 million on research until 31st March. So the research was conducted in the month of January, February, and March. So 3 million will be the value of the research. which will go in the income statement. At which date the project passed into the development stage. From this date, it spends 1.6 million per month. So from April onwards, the company is going to incur 1.6 million on the development of the project. Until the year end 30th June 2005, at which the development was completed. However, it is not until 1st May that the directors of the Boston were confident that the new product would be commercial success. So that means for the month of April, the criteria are not met. So the amount of development will also go in the income statement. It will be 4.6 million, which will go in the P&L. And we can capitalize the development from the date when it becomes probable that this development will give you a benefit. So May and June, for the 2 months period, the development cost will be capitalized on the face of the balance sheet. So 1.6 plus 1.6 million. 3.2 million will be capitalized on the face of the balance sheet as a non-current asset. Very good. So it's 1 minute left before ending this session. So I want all of you guys to attempt this question from the Kaplan and these two questions. We have some questions of IS 38. Please do attempt all the questions. And from the next class, we will start from IS 36. So we will be covering IS 36, then leases, IFRS 16, and then revenue, IFRS 15. Then we are going to cover IS 12, that is taxation. Okay. So what you guys need to do, so these are the IS 38 questions. That's your home assignment. I'm giving you the home assignment till the next class. First, you need to revise all the slides along with the questions that we have done. In the handout section, there is a practice handout of day 1. Believe me, if you follow all my instructions, I will be able to make you to score 80 to 90% marks from section A. And believe me, if you can score 80 to 90% marks from the section A, that means more than 40 marks in section A and B. Then you will easily pass this paper by scoring even just 10 to 15 marks from section C. So it's very important that you need to follow all the guidelines which I am telling you. Okay, that's the practice handout. I'm sharing with you guys. Yes, that's my practice handout. You can see on the screen. That's available in the handout section. These are the questions that you need to attempt. These all are MCQs and related to section A and B. So do questions from IS 16. We have already covered IS 16. Then IS 2. Then IS 38. Attempt these questions from IS 38. Then these are related to IS 36. So you do not need to worry about IS 36 right now. So don't attempt questions of IS 36. And then we have questions from after IS 36. IFRS 5, we haven't done it yet. So don't need to work. Yes, IS 20. We have covered IS 20 government grant. So all of you are required to attempt all these questions. So these are most commonly asked exam related questions. So if you will be in a position to attempt these questions, you will definitely be able to have a sound group on these standards. And these standards, believe me, are very close to the heart of the exam. These are in fact important for this session as well. And please give your valuable feedback about today's session. Did you enjoy the session today? And did these sessions are useful for you guys? Did they help you in improving your concepts about IFRSs? And if you follow all my day-wise handout and attend these 5 days webinar, inshallah, I can give you the reasonable assurance that you can pass the paper with very good marks. And again, I'm giving you uh, a suggestion that those students who got flunked previously are requested to contact me personally. You can even call me, you can message me, or you can discuss whatever the problem that you are facing in passing this paper with me. I will give you a separate special plan for you guys to pass this paper. But do not discuss your issue on the group. Just send me the message personally. So tomorrow we will start the session again on the same time at 8:30. Please don't miss these sessions. These are free of cost, highly expensive, valuable sessions for you guys, which is provided to you by the ACCA free of cost. So again, I want to thank ACCA, and you all must be thankful to ACCA as well, because they are giving you this resource without charging anything, and spread the message of this session to other students so that maximum students can get the benefits from these free live sessions. Thank you so much. Do take care of yourself, and we'll meet you tomorrow on the same time on this same platform. Allah Hafiz.